Hello everyone and welcome to this new video. This is going to be a new series that we're starting where if you have any specific questions about stocks or investing, you can leave them in the comments below and we will do our best to create videos explaining the answers to those questions. In this video specifically, we're going to be talking about what is beating the market. And most importantly, what we're going to do is I'm going to share with you some case studies of people that have done it and how they've done it in the past. So this way, if you're looking to beat the market yourself, you'll be equipped with the tools that you need and you're gonna be able to have a lot more solid ground to embark on this journey. Okay, so beating the market is something that is consistently talked about in the investment world. And if you think about it, it really makes sense because I'm sure you've heard over and over and over that beating the market is quite a difficult thing to do. And if you can do this, then that puts you in the top percent of investors who have an edge over all the other ones that tried and failed. So before we get more into what beating the market is and potential strategies that you can implement to do this, what I want to go ahead and do is explain to you what beating the market means in the first place. So as you can see, we have a graph right here and I'm just going to make it bigger. And in this graph, we see different dates. So in this case, the axis is the time. And in this case here, we see the portfolio returns in terms of a percentage basis. The main thing to look at here is this red line right here. So this is the S&P 500. And in this case, you can see that the value of this line goes up and down over time, sometimes quite drastically down, and other times it goes up, and up. And the other line, the white line, it signifies the performance of somebody trying to beat the market. So in this case, you can see that they're very clearly beating the market, and it shows that this person did everything right and they were able to beat the market. So in this case, you can see that always their returns have been greater than the red line, which in this case is the market and is represented as the S&P 500, which is a collection of the biggest or the companies that have the largest market cap and listed in the United States. So you can see that this person did everything right. So in this case, this investor would be beating the market. Another way which I think is quite helpful in terms of looking at what it means to beat the market is doing this. So you can just go ahead and Google S&P 500, and then once you do this, this will return the stock price over time of the S&P 500 index, and you can look at this over different periods of time. So for example, let's say that we want to look at this period. So you can just click here, hold it, and then you can see what the returns that you would need to have in order to beat the market. So let's say right here we're looking at the date is May 15, 2020. So if you wanted to beat the market from May 15, 2020 until July 9, 2021, that means that your portfolio's performance would have to be greater than, in this case, what you can see right here, which is, well, you can change it, but in this case, let's say it's 52.58%. So if you're able to achieve that, then in that case, over this time period, you're technically beating the market. So now let's talk practically about different ways and different things that you need to keep in mind if you're trying to beat the market. So this is based on an article that we wrote. This is going to be linked in the description, but if you look right here, some of these different tips, there's a lot of fundamental but very important things that you need to keep in mind when you're trying to beat the market. As you can see, one of the most important ones is to get your finances in order. So that means before you're trying to beat the market, you should be set financially well. You don't have to worry about the day-to-day bills that you have to pay, because if that's the case, it's going to be very hard to have the focus and the resources to be able to achieve this. In this case, there's some other tips. So this one is kind of debatable, but for example, this one is absolutely critical. If you want to beat the market, one of the best ways to do this is to have as low a fee as possible in terms of when you make trades. If you're paying high fees already, you're starting from a bad place because that's automatically going to eat away from your returns. So be very careful with the fees that you pay. And then the other thing that's absolutely key for anybody who's looking to beat the market is to take advantage of tax efficient investment accounts. So in this case, the way that that you can beat the market is to invest through different investment accounts that are available depending on the country where you're from. So in Canada, there's like TFSA's accounts. In the US, I believe there's Roth IRAs. So those accounts are really good because it's not only about beating the market, but once you sell your stocks or your portfolio, you're going to have to pay taxes in most places. So therefore, the lower of a tax that you can pay, the higher your returns are going to be. The other thing is the whole FOMO thing. So a lot of people hear about, in the past, like it was Bitcoin or any particular companies, and they're like, okay, this is it. You have to invest right now. Don't ever feel like that way. There's no one perfect investment opportunity. There's investment opportunities all the time. The main thing that matters is for you to stay consistent. And this is the key right here, to do your own research. If you investigate and you do a lot of research when you make your particular investments, you're going to be ahead of most investors out there. And this is ultimately what I believe will give you the greatest competitive advantage and the greatest chance to be able to beat the market. Because, and this is the perfect transition, if you look at some of the investors that have beaten the market in the past, so Carl Icahn, George Soros, Peter Lynch, Warren Buffett, the way they have done it for the most part has been to do a lot of research, to dig into the fundamentals of the particular companies, to look at companies that maybe have been overlooked by the market but still have a lot of intrinsic value built into them, and to be able to invest in those companies where their market price is way lower than the intrinsic value, and then over time they're able to reap those rewards. So how do you do that? Well, one of the best ways to do that is to be able to analyze the fundamental value of a company and then determine whether or not you should invest in that particular company based on that. So I'm just going to give you a brief overview. We have a whole dedicated video that you can check out on this, but let me just give you a little overview. So there's many ways to value a company. There's different valuation models that you can use. For example, in this case, we have the earnings power value model. There's also DCFs. There's dividend discount models. There's a whole bunch of different techniques that you can apply to different companies to be able to get a good answer in terms of what the potential value of a company is. So in this case, we're looking at the earnings power value model. The cool thing about this is that instead of building the model from scratch, you can just leverage this model or other models available. So for example, if you go on the White Sheets add-on and you navigate right here to Wise Templates, you're gonna be able to download a whole bunch of different templates for free that you can get. So in this case here, we're looking at the earnings power model, we have DCFs, and there's a whole bunch of other different valuation tools that you can check out. What these tools allow you to do is they provide you with all the data that you need in terms of historical data to be able to calculate certain numbers. And in this case, you can see here, it's using Wise functions to be able to retrieve the data that we're requesting. So in this case, we're calculating the average EBIT. And then here on these other sections, we're doing some other calculations as well. And then anyways, the point is that after you do all those calculations, do your research to select the right numbers in the first place, you're gonna get earnings power value model per share, or in this case, the intrinsic value per share of that particular company. You compare it with the current share price, and then you can easily see whether or not this is a good opportunity. So in this case, this is not a good opportunity. Why? The answer is very simple. The current share price is way higher than the actual intrinsic value of the company. So this is a concept that it's absolutely critical for you to keep in mind if you're trying to beat the market using a fundamental approach. The cool thing about this as well is, let's say you're analyzing another company. So in this case, let's say Tesla, and now here we go, we get the answer. So in this case, the downside is high as well, but this is just one valuation model. You can look at many different valuation models, and the key here is things like the assumption. So in this case, the WACC, it's absolutely critical, and different valuation models give you different answers. So it is important for you to be able able to look at all those models, do your research to make sure you have the best assumptions possible, compare the numbers, and then that way you can be a lot more equipped to make good investment decisions that ultimately allow you to beat the market. Now you know what beating the market is, and now you have a more solid ground base in terms of knowledge that you can use to be able to achieve this goal. If you've enjoyed this video, make sure to subscribe and turn on the notifications on so that way you get notified every time we release a new video like this that's going to allow you to take your investing game to the next level. I'll see you in the next one.